Welcome, everyone. My name is Chris Desi. I am the Chief Revenue Officer here at Diamond Standard. We have a treat for you today. We've got three CEOs from cutting-edge alternative investment companies. We're going to spend an hour with everybody today, and we're going to get into it. We're going to talk about the current economic climate. We're going to talk about how to navigate uncertainty in 2024, and take a bit of a deep dive on why investors are pivoting to diamonds, farmland, and whiskey in the new year. And we've got senior leaders in each of those companies. We've got Cormac Kinney from Diamond Standard, Anthony Zhang from Vinovest, and David Chan, who's helping us out. His CEO Artem, unfortunately, is a bit under the weather, so we greatly appreciate David joining us here today. I'm going to take 2 seconds just to make sure that everybody can get a little bit more learning about these gentlemen. So I'm a bit biased when I talk about Diamond Standard, obviously, as I'm Chief Revenue Officer here at Diamond Standard. But Cormac is, I can say definitively, the smartest human being that I've ever met. He's a quant finance pioneer, named to Forbes 30 Under 30 list in 2017. Launched Diamond Standard in 2019. Diamond Standard, for those of you that don't know, we're going to get into it a little bit, but I believe it is the most unique business that I've ever encountered in my career. I think you're going to feel the same. You hear a little bit about that. He's got multiple degrees from Carnegie Mellon, and he is a visionary leader here at Diamond Standard. I'm honored to work for him, so welcome to Cormac. Slide on. There we go. We get the wonderkind here when we talk about Anthony. I always feel a little bit, like I'm behind the eight ball with my career when you start reading through Anthony's resume. Founding and selling 2 companies, Envoy now and Know Your VC by age 23. I think I was still at keg parties when I was 23, so very impressive stuff. Launching Vinovest in 2020. Not the easiest year to launch a business. And right now, the marching orders for the Vinovest team is to eliminate time-consuming research and investigation that investors typically need to conduct before investing in wine. I've had the pleasure of interacting a lot with Anthony's team at Vinovest. We've gone to events together, and he's got an absolute powerhouse of a team with Vinovest. So excited about learning more about what they're doing in 2024. And then, of course, David, again, thank you so much for joining us. I think we've got the cream of the crop here. CCO and Head of Business Development at FarmTogether. FarmTogether, for those of you that don't know that are on this, because I know that we've co-marketed a lot of this. We have close to 400 people that are on the webinar with us currently. He is CCO and Head of Business Development at FarmTogether, and they are Farmland investment manager. So they leverage technology and data to facilitate access to high quality farmland assets across the United States. I guess he got an MBA from a kind of an average school, Harvard Business. So we're honored to have David join us, and we're gonna get right into it. And let me stop sharing, and then we could get into the Q&A. Wonderful. Anthony, you're first up on the docket. So welcome. Nice to see you again.
Chris.
The opening question is, we know things are turbulent, right, within our current climate. How do you and your investors navigate these conditions? What's your perspective? Like, what's the thesis from Vinovest?
Yeah, our thesis and really the impetus for creating this business is that, really to navigate uncertainty and volatility. And I think similar to the three of us, you need diversification, right? And not just diversification amongst equities and bonds, right, which you can find, but really into alternative asset classes. And even with wine and whiskey, right, there are certain regions and certain types of wines and whiskeys that may be doing better than others in some years, and others, in times of volatility that can provide a strong hedge. And I think that is a perfect, really example of what a lot of our three asset classes can do within a broader portfolio. So when we do talk about uncertainty and navigating our investors through it, we really do look to not only what we're seeing currently in the market and how these long-term assets like wine and whiskey really don't have a lot of correlation to the broader markets, and especially during higher interest rate periods, but also how it has fared not only during this cycle, but the past 2-3 cycles that we have seen in higher interest rate environments. So looking towards historicals, right? Things don't repeat, but they often do rhyme in terms of history. And then also being able to talk our investors through their unique situations as well. I find that coupled with our current data is really the key to my own perspective on how we navigate this pretty unprecedented time.
I'm glad that you mentioned that you spend time with the investors, because, and I'm also glad that I mentioned that I spent time with your sales team at a few events, because I do know that it's a bespoke process when investors are choosing to invest in Vinovest, where they kind of walk them through all the trials and tribulations that they might encounter if they're investing. Cormac, share with us, how does Diamond Standard offer a unique opportunity for investors, and what inspired its creation? Because from my perspective, somebody that's been here almost 3 years, I find the genesis of Diamond Standard to be one of the most fascinating aspects of everything that we do here.
Yeah, so I spent 20 years or so building trading systems, and many years as a quantitative portfolio manager. Trading everything under the sun. And it's because of my wife, who's a jewelry designer, that I got exposed to diamonds. So it wasn't like a lifelong, interest in diamonds that brought me here. It was really a fintech approach. And diamonds are this unique natural resource that is worth more than all of the silver, platinum, and palladium in the world combined. But investors could never invest in diamonds because they have this annoying and attractive feature, which is that every diamond is a little bit different. So they have different carat weights and colors and clarities, and all of those factors have a huge impact on the value. And by the way, they're nonlinear, right? So it's not like there's a easy factor model or algorithm where you can know what a diamond should be worth. And because of that, that subjectivity and a real lack of transparency for diamond prices, this huge natural resource could never be accessible to investors. Even though it's, they all hold silver and gold and other precious metals, they could never hold diamonds because of that lack of price discovery, lack of transparency, lack of any types of tradable products. And so that really got my interest as a developer and computer scientist. And I believed that all the technologies that I spent the last 20 years perfecting, things like automated market making and optimization, which we use in portfolio construction, and statistical arbitrage that we use in trading, all those technologies could be used to, for the very first time, create a tradable product for diamonds. And I'm sure most people have seen it, but these are Diamond Standard bars, and the diamonds are inside. And the breakthrough is that these two bars are equivalent. And we've been very fortunate that we have regulators that have agreed to oversee that process. And because of that, these commodities are now deemed good for delivery. These coins can be used to settle CFTC regulated futures and options. And so what we're doing is basically creating for diamonds all of the financial products that you've always had access to for gold, things like futures and options, ETFs, and allowing people to create an allocation.
Love it. And I feel like the point of having now made something accessible that was previously not accessible to investors is hugely compelling, especially for this audience. And which leads me to David. I have two questions about Farmland. Why was it previously inaccessible? Because I don't know if a lot of people would know or understand that. And typically, who's investing in Farmland? Because I do find that fascinating. We have an analyst here who went to school in the Midwest and came back from Indiana and was very excited about investing in Farmland because he had met students that he was in class with whose families were big investors in Farmland and doing exceptionally well. So we'd love to hear about that. Who's investing with you guys?
Certainly. So just a little bit of the history of U.S. farmland, at least. So, there's certainly media out there that would suggest U.S. farmland is industrialized, and to some extent that's true. But compared to other agricultural producers, most of our farms don't have runways to support planes delivering products. So actually, we are a fairly small farming nation, just in terms of footprint of an average size of each farm. And a lot of that dates back to our history. So if you look at the Homestead Act, which encouraged individuals to take up farming in the West in order to spur economic expansion in the West, it really set up these small lots of land that became assets and stores of wealth for families as they operated that land and transferred it from one generation to another. And so that's the DNA of U.S. farmland today. And for the past few decades, I would say for the past couple of centuries, these farms have stayed within the family, being passed down from one generation to another. We are on the cusp of a very interesting time in U.S. agriculture, as we are starting to see families look at estate planning and, for the first time in their history, consider selling a portion or all of a farm to an outside party, because the next generation is either not equipped with the know-how of how to farm, does not want to farm or have an interest in farming, or has moved away from the family farm and has no way of easily managing the asset. So that is a big factor today that we are just seeing underway. And the USDA, which produces surveys around statistics and expectations, believes that roughly half of all US farmland in terms of acreage is going to trade hands over the next 2 decades, which is a pretty stunning number. So we think that there's a lot of activity that's about to occur in our space. And largely, that has been one of the reasons why it's been such a high hurdle for outside parties to invest in farmland. There's also natural barriers as well. Farming is a science of its own right. It involves agronomy, it involves meteorology, hydrology. There's so many specific fields that come together that can influence the success of a farm. And so it is complicated. And for someone to take up direct management of a farm without having that background or training is quite difficult, quite time consuming. And so historically, going to your second question here on who invests, we've seen mainly large investors, institutional investors, act as non-owner operator investors in US farmland to date, because they have essentially capital that can be deployed at scale to contract out farming to third parties. And so they don't need to worry about that management hurdle themselves. What we are trying to do at FarmTogether is increase that access to more investors by fractionalizing ownership and offering different products which make farmland a bit more accessible. And we'd like to see that, that shift in sort of the ownership of farmland become a little bit more balanced, where today only 2% of farmland is owned by non-owner operators, and that is, just hardly anything compared to most other mainstream asset classes. We think by growing that number and bringing more investor dollars into farmland, we'll be able to support the next generation of sustainable farming in the US.
I love that. I feel like we're all part of a movement that's democratizing these investments for individual investors as well as institutions. Similarly, I'm sure you can see Cormac itching to talk about the percentage of individuals that own diamonds is about 2% of the $1.2 trillion market, whereas other metals is about 15%. So that delta are the green pastures ahead of all of us. So Anthony, for Vinovest, we all know about what we're wrestling with interest rates, and I'm curious, how does that impact your asset class? I know that you guys have wine and whiskey, and why are individual investors that are interacting with you guys, why are they opting for investing with Vinovest in terms of those interest rates?
Yeah. So, when we're looking at the correlation between interest rates and our asset classes, I think it's really important to understand what really drives the price of a whiskey barrel or, a case of wine, right? And a lot of the hard costs that are built into that, right, are often also associated with the cost for inflation, right? You need people to be able to work in terms of the vineyards, right? Or in terms of the barley, the wheat, to be able to actually make the base spirits for the whiskey, or for the grape juice for the wine, right? So all of those happen to become more expensive, as well as the cost for the actual equipment, the gas needed to actually power this equipment. And then also when you're thinking about the final bottling costs, or the cost to be able to actually have enough lumber for the barrels, right? All of that is factored into the increasing prices of wine and whiskey, and that's on top of just the global demand, as well as this is becoming larger and larger of a topic, but the climate change that is impacting the yields and the yield consistency of these assets. So when we're looking at the correlation between it, we do see that the appreciation rates of whiskey barrels, right now are at around 15-16%, right? Far outpacing the pace of interest rates, even given the recent hikes. It's similar in the wine world, right? It's been a lower appreciation rate on average last 5 or so years, around 10%. But we've seen both assets be able to comfortably outpace inflation rates as well as interest rates.
Investors must be pretty happy about double digits. That's always a good thing.
Yeah,
So Anthony, you touched on some of the macro things that impact wine and whiskey as an investment in terms of global warming, weather, et cetera. Cormac, how does Diamond Standard get impacted by the traditional diamond market and what's happening from I guess the broader investment landscape that's happening globally around diamonds?
Yeah, well, the underlying macro theme for diamonds is clearly the supply and demand dynamics, and it's very interesting because it's a unique market, and there originally wasn't a lot of transparency, but for the last almost 20 years, De Beers has been public, and so we know all of their production, we know their inventory. And most of the mines are now public. And so we have a lot more visibility, at least at the rough level of the supply. And what we're seeing is that, incredibly, they haven't discovered any new diamond mines in over 25 years. When I was growing up, I remember hearing about diamonds being discovered in Canada. And that's been really the big new source, but still the majority of diamonds are coming from South Africa and Russia. And there's actually only about 47 mines that are currently operating. And by mines, I mean the pit mines that are kimberlite pipes that are concentrated sources of diamonds. The other sources are like riverbeds that wash through an ancient mine, or seabeds that diamonds got washed out to sea. But the real mother lode is when you find a pipe. There's been no pipes discovered for 25 years. And there's 47 that are actively in production, and all of them are projected to be completely depleted in about 45 years. And in fact, half of them will be depleted in about 12 years. So the supply of diamonds is rapidly running out. A lot of people are surprised by this. And the production has been slowly declining. But the other side of that is obviously the demand. And diamond jewelry demand has relatively steadily been growing about 3 to 5% per year over the last 15 years or so, there was a buildup. A lot of that came from China. And obviously there was an impact of COVID. COVID actually drove diamond prices up very substantially because several of the mines got shut down to put protective protocols in place. And so the inventory got depleted, but a lot of consumers were shopping at home online. And so jewelry sales really grew in 2020 to 2021. In 2022, what happened is Russia invaded Ukraine, and Russia supplies about 30% of all diamonds, and they started to flood the market between 22 and the first 3 quarters of 2023. That plus the fact that China's demand didn't resume because China is in a recession of its own and they stayed in lockdown, drove diamond prices to actually come all the way back down to where they started pre-COVID in 2020. So supply demand created this unique run up and fall. But what we see long term is that the macro supply and demand will win out, and that diamond prices must inevitably go up. A lot of people ask about synthetic diamonds, and those are really tremendously marketed. But the wholesale price of synthetic diamonds are about 1% of the value of a natural diamond. They're marked up tremendously by the time a consumer gets them. But it doesn't seem like synthetic diamonds have actually eaten much into the actual revenue of natural diamonds. It's more the economic, short-term trends of recession and depression around the world. But we think long-term, the biggest impact on diamond prices is going to be financialization. And if you look at what happened with gold, the first gold ETF launched in 2002, and over the next several years, 7 or 10 years, gold went up 500%. Silver went up 200% after the first ETF was launched. And more recently, uranium prices doubled after the very first uranium ETFs. They acquired about $5 billion worth of uranium over 3 years. So I think financialization is the biggest driver of price change.
Incredible. It's interesting how all of these turbulent things in what we're all experiencing are impacting these investments. David, what makes farmland a go-to asset in your mind and from your perspective, especially during recessions?
There's a lot of factors at play, some that have already been mentioned. I think just starting off, my gut reaction to your question just now is a common answer, which I share, which is people will always need to eat. So we are perfectly inelastic. We have to eat. We have to produce food. So that is one tailwind we don't see going away for farmland. But we are also experiencing a lot of the macro changes that have already been mentioned, from climate change impacting suitability of areas for farming, yields, water availability, natural risks like flooding risk and drought risk. So all of that on sort of the climate change and weather side. And then we also have just a fundamentals shift underway. So similar to the supply of diamonds, as Cormac was mentioning, and not finding new mines, we've been seeing U.S. farmland decline at an alarming rate, largely due to development. And so we're seeing lots of farming acres taken out of operation, and that land being used for quote unquote higher use purposes like commercial real estate or other real assets at a really stunning rate. Between 2001 and 2016, we've lost around 11 million acres of farmland in the US. So to contextualize that, that's roughly twice the size of Massachusetts. So I know, anyone who's in California, Massachusetts seems like a pretty tiny state, but it's actually a ton of land when you think about it.
Pretty substantial, yeah.
So we continue to see that trend emerging, and we believe that having a domestic food supply is really imperative for a number of reasons, from being able to control food quality and food safety to also even national security. And so
I was
there's
just going to say, I'm like, as you were going, I was like, it's got to be a matter of national security. Absolutely. Yeah.
Of course. So we're certainly seeing those trends underway, and similar to I think of a lot of alternatives, certainly wine, whiskeys, and diamonds as well. We have a pretty differentiated return profile, and we're pretty uncorrelated with how the general market moves, because it is such a unique market that has its own fundamentals and its own quirks, give or take. And so thinking about the inflation that we've seen over the past couple of years, at least for farmland's always been positively correlated with inflation. When we look at the past 3 decades worth of data that we've seen positive relationship there. And that's really because agricultural commodities are used in so many different inputs, from food to fuel to even consumer goods and staples. And so it's ingrained in the economy. It's both good and bad for us on the farming side, because even though food prices might be going up, cost of goods sold also go up. So we do see that on the COGS side as well. But overall, we think it's pretty well positioned for inflation, just because we do see that offset in retail pricing moving, and we're sitting on top of a real asset that's appreciating over time. And so that has generally been a favorable factor for farmland, in addition to just the uncorrelated nature of the asset class, given the fact that people will always need to eat.
It's interesting. I find it fascinating that each of these investment vehicles tend to be perceived as risky. People hear, an alternative, and they're like, "Oh gosh, that's so risky," but largely uncorrelated, hedge against inflation, store of wealth, et cetera. It seems as if it's these are the safest plays. Anthony, how do you guys approach investors that have the preconceived notion that Vinovest as an alternative might be a perceived risk, and like, how do you guys approach facilitating due diligence for your investors?
Yeah, I think that's a great point, right? I think what most people don't understand, or if there's not enough sufficient literature out there, right, you're going to perceive that there's a lot of unknowns, and unknowns can be scary and risky, right? So it's totally understandable and natural for prospective leads and clients to come in with that perspective, right? But I think when it comes to navigating risk in our asset class, I think that the first thing to really talk about is the long-term nature of it, right? And I think when things are long-term, right, volatility inherently does get smoothed out. And with something like a whiskey barrel, right, if we have a brand new whiskey, right, a new make, and we know that we're going to have demand at year 4 from 5 different brands, and they're all bidding on the future value of our contracts, right, and we lock one of those in, or at least have an option to sell one of those at year 4, right, it really does help to de-risk that we have already, at the point of entry, an exit opportunity that we know from, our partnerships and our relationships is going to be able to provide liquidity for investors at a certain point when they want it. And when it comes to navigating the risk in their asset class, the main thing is just storage, right? Wine and whiskey, right? They are fragile, right? It's not like a digital stock where they can't really be damaged. It absolutely can't be damaged. So the main thing that we de-risk at Vinovest is custody and insurance. So if anything happens to that barrel of whiskey as it's aging and maturing, whether it be be damaged, or the temperature and climate is not right, or it somehow gets destroyed in the warehouse, we have the right insurance to be able to at least collect on the full value of that particular barrel and protect the asset. So that's the number one risk that I always tell investors looking into any real asset, but particularly this one, where you really just want to not bother it as it ages and matures, and protect it to make sure the climate and temperature and it's away from vibration and sunlight, and that's consistent, so that it can just do its thing, age, get to maturity, and when it's at maturity, get bought by a larger brand that wants to then bottle and sell it to the consumer market.
Yeah, it's interesting too, because I do think having optics into being next to your team at an event and hearing that question does come up often. So I'm glad you spoke about that. That's great. And at that event, similarly, Cormac, when people were speaking to both the Vinovest team and Diamond Standard, we were talking about the benefits of it being, Diamond Standard and Vinovest being a store of wealth, as well as a hedge against inflation. Can you walk the listeners through how Diamond Standard is a definitive hedge against inflation?
Well, when you look for a hedge, you look at the price history and you look for things that are uncorrelated. And we, for example, we're really kind of surprised that when you look at diamonds going back 20 years, they're literally uncorrelated to everything. They have a 0.02 correlation to stocks and bonds, around a 0.6 correlation to gold and silver, which is the most surprising. You would think, gold and silver, they're about 0.78 correlated, so extremely highly correlated. You would think diamonds would be somewhere with a correlation to gold and silver, but it turns out it's actually near zero, which is very surprising. And as a quantitative portfolio manager, that's extremely attractive because it means it's an all-weather asset that regardless of what's happening in the rest of your portfolio, this should not go with that crowd. The other aspect is volatility, and what happens during times of dislocation. And we've all seen as alternative, asset managers, we see that stocks during a time of recession, like 87 and 2008, stocks can lose tremendous value very, very quickly, and things that weren't correlated before become correlated. And I was a quantitative portfolio manager in 2007. Suddenly everything became correlated and everything lost price. It had, went down in price because of liquidity issues. So liquidity tends to correlate everything. Diamonds are interesting because they don't have correlation. They also have relatively low volatility. A lot of that is because they were not financialized. There were no futures contracts. We now have approval for a futures contract, and we expect that most likely to launch this year. And that will open up the asset to a lot more investors. It'll also allow them the ability to hedge for the very first time. So if you're a diamond miner and you want to hedge the potential risk of price volatility, soon you'll be able to invest in futures contracts. Or conversely, if you're a institution that wants to build a $100 million position in diamonds, you can also sell a contract that allows you to put that commodity if it loses money. And we're talking to large jewelry buyers, like jewelry companies, that are willing to take a premium, like $1 million premium, to hedge the risk of an investor, hedging their volatility risk. So yeah, that's how we look at the volatility, and that's institutional perspective is most interesting. What I'm most interested in is what's the price going to do. As a smaller investor, you want something that cannot go to zero, and farmland and I think people always drink wine and whiskey. Stocks can go bankrupt, bonds can default, diamonds cannot go bankrupt. And so that's an attractive feature. What we saw in October of 2023 is that the diamond prices fell to a level that the producers refused to sell. And that really looked like a floor. And so now we think diamonds are likely to appreciate as they're financialized. And that's what I'm most interested in, is returns versus hedging.
It is interesting. It's kind of like, when things went sideways during COVID, you'd think that people would not be drinking wine and whiskey. But I think in 2022, I think it was whiskey was the best performing alternative investment of the year. So people took a deep dive in that investment. We're going to pick on an investment vertical that's not here. So David, I want to hear from you about how does farmland differ from real estate investments, particularly in recent performance? And I'm asking that very specifically because in my role at Diamond Standard, I do interact a lot with our investors on a day-to-day basis, and this comes up, right? They're talking about diversifying their portfolio. They're talking about different types of investments, different investment vehicles. It's not just, let's just talk about Diamond Standard, which is why this platform and this webinar, I think, is so impactful for us. So let's pick on real estate a little bit.
Poor real estate, not but we think farmland investing really complements traditional real estate investing, and particularly because farmland is historically a greater supplier of stability and growth, just given the fact that, you know, the fundamentals we just talked about around the stickiness of supply and demand for this market. So overall return profiles for farmland compared to traditional real estate are going to typically be lower. But again, there is a different, it's a different return on a risk-adjusted basis, we would argue, just given the fact that that it is a completely different market with different fundamentals. I think in our current state right now, in 2024, and looking at what's occurred over the past year, you know, we see residential real estate at, you know, recent, if not historical highs. We see commercial real estate experiencing a lot of pain. And I think the biggest differentiating factor between some of these more traditional sub-asset classes of real assets, like residential and commercial versus farmland, is really leverage and where rates have been for the past couple of years. And so if you look at, say, commercial real estate, typical leverage profile is 50% LTV, loan to value ratio, all the way up and, you know, to 90% loan to value ratio. So highly levered sub-asset class. Farmland has typically a much lower leverage profile. So on average, the debt to asset ratio for farmland in the US is around 13%. So it's a much lower leverage profile compared to other forms of real estate. And so while I won't say farmland's totally insensitive to rate movement, it's going to be far less sensitive to interest rate movement than another real asset or another real estate investment like commercial real estate that might have, you know, a 90% LTV. So that's certainly one aspect, and I think the driving force for what we've seen in terms of performance as of late. What we track as sort of our benchmark at FarmTogether is the NCREIF index, the NCREIF Farmland Index. The NCREIF is a group that surveys and aggregates institutional level performance of real asset investment. And so the group is the National Council of Real Estate Investment Fiduciaries, and they have a farmland subindex. They also have a real estate subindex, and so you can track performance of farmland versus real estate and some others as well. And the Q4 data for 2023 comes out today. We tried to find that data before the webinar, and unfortunately it wasn't out yet, so I don't have those numbers for you, but they will be out later. But year over year through Q3 of 2023, the NCREIF Farmland Index had delivered a 5.8% return, where the NCREIF Real Estate Index had delivered a minus 8.4% return. So really stark difference. And I think, you know, the biggest explainer of that is going to be the fact that farmland is lowly levered. At FarmTogether, most of our deals recently have been cash only. We really only look at debt financing if it's accretive. And credit in farmland has completely changed. We don't have time to go into the details of it, but basically after the 1980s, it was an over-leveraged asset class. Lenders completely changed the way credit was priced and how credit is extended. And so the entire asset class became much lower levered as a result of that. And so, you know, seeing interest rates where they are today has had a far less impact on farmland as it has on other real estate investments. One last thing I'll mention on this, we have seen a lot of activity in the exchange space. So real estate investors who are looking to exchange or sell other real asset opportunities that they're invested in. And at FarmTogether, we do offer 1031 exchanges through a couple of different products. And so that's been helpful for investors looking to diversify their real asset investments out of, you know, say just a commercial real estate portfolio or just a multifamily or a residential portfolio, while still staying within the guidelines of what's considered a like-kind exchange for 1031 purposes. So that's been an interesting trend we've seen lately over the past year.
It is fascinating, and the fact that the report didn't come in, I think, is fine, but it you're reminding me at 40 minutes after the hour, I do want to mention to everybody that's in attendance, because we do have a few hundred people right now, that if they do have questions, like if you had a specific follow-up for David, and if you're interested in getting that report eventually, email hello@diamondstandard.com, and we will disperse the questions to the individual companies and have them follow up with you, depending upon whichever question that you may have. Thanks for that, David. That was fascinating. Anthony, you mentioned earlier the insurance in the investment because things could go wrong, right? Can you talk a little bit more about that security where, how are the investments secured in custody? Do you have specific relationships? Like, can you talk in a little bit more tactical detail about that?
Yeah, happy to. So we have bonded warehouses that are located all around the world. So for example, with where all of our single malt scotch is stored, it's in a bonded warehouse in Scotland, right? Where the bulk
Where
of our
exactly?
wine is
I'm asking for a friend.
No, but all jokes aside, we actually do twice a year trips out to these locations for investors who are interested in seeing them. And the good thing is this is an asset that you can enjoy. So we usually make a good trip out of it, right? They'll play a few rounds of golf, go get to taste, take some barrel samples out, as well as just see our operations, right? And see how we protect their asset. And of course, also be able to see that the asset is actually there, right? I think that's also one of the, more frequent questions that we get is, how do I know this asset actually here, right? And I think in the case of all of our assets, the great thing is we can actually point to an actual location and show them like, hey, this is actually what you're investing in, right? There is that inherent value in this thing that has, that is created, right? It's not just, a digital copy of a cat that,
something that you could hold in your hands and even ingest.
But back to insurance, right? They're all bonded, which means they're in a tax exempt area, which makes investing tax efficient for our investors. We have a lot of international investors, and a lot of the European countries, as well as some Asian countries such as Hong Kong and Singapore. There's a really advantageous tax law for spirits and wine called the wasting asset rule, which rules that since wine and whiskey are consumables, capital gains taxes of up to $6,000 are actually exempt. So a lot of our investors, because of that law and because of the tax-free status of these bonded warehouses, are taking advantage of that. We have a very robust insurance policy that protects against anything going wrong with the warehouse. And we also only deal with trusted parties, which what that means is we won't buy, say, your wine collection or someone else's whiskey collection if you're an individual collector. We typically don't buy from auctions either, right? We usually just source directly from the distillery or directly from the winery because we want to know that wine or whiskey is in the best condition, right? And if it came straight from the source, we can guarantee that. But also that also guarantees the best price, right? We're not searching on the secondary market. We're able to have those direct relationships, which allow for a lower entry price for our investor, right? Which means that you're at a better starting point for long-term gains.
Very cool, very interesting, and I expect an invite to Scotland at some point in the future.
Our next one in the summer, I think in July, and it's.
I mean, I'm in, man. It just sounds so it's so cool. What a great trip, right? You're checking on your investment and enjoying yourself. Fantastic. Cormac, we didn't get into it too much, but for my background is technology. I've been selling in tech for many years, and then came to Diamond Standard. And one of the big reasons why I came to Diamond Standard was all of the technology and the exercise in computer science that you created here at Diamond Standard. And we're talking about security, and we're talking about ensuring that there's something that's fungible behind people's investments for farmland, wine, whiskey, as well as diamonds. Can you talk a little bit about the technology that impacts Diamond Standard's operations?
Yeah, it was an interesting path that we went down, which was to make our commodity. We had to make very transparent and very public record of what are the diamonds inside each coin. And we have to be able to prove that the diamonds in here are equal to the diamonds in here. And so that means all of the certificates, all of the Kimberley process, which means that the diamonds are not sanctioned, not blood diamonds, all the proof that the diamonds have been inspected, that had to go with the commodity whenever it transacts forever, throughout the future. And so the blockchain is what made that permanent public record possible. And so we publish all of our data, it's all transparent, onto a public blockchain. And we wanted to record that. So we record that data on a wireless chip that's inside the coin. What we realized is that unlocks a really valuable feature, which is that the coin itself, first of all, has all of its provenance, but when the coin is delivered to a vault, we built wireless technology with Brinks in the Brinks vault in Delaware, that the coin itself issues to the owner a vault receipt. And that's also a blockchain token. And we got a regulatory license. Our whole product is assembled under regulatory supervision, and it's audited by Deloitte, that production. But the regulator allows us to issue a token that's a vault receipt. And the benefit of that is that I could sell my vault receipt to Anthony, and now he owns this coin sitting at Brinks. And so what we built is a real-time peer-to-peer exchange. And for all the coins, about 95% of all the coins we've ever made, they're sitting in custody in Delaware in a trust. And anybody who goes through our KYC process, they're able to buy and sell coins in that marketplace 24 hours a day. And so that provided liquidity for our investors. So you can buy a diamond standard commodity and you own it, you've taken delivery at a custodian, and you can trade it anytime you want. And that market price is what populates the price history on Bloomberg. So Bloomberg now publishes the Diamond Standard Index, and that's the price we sell at. We don't set the price for the commodities. We don't come up with a price for diamonds. We have no opinion, actually. Our job is to produce a commodity that's always the same, and then the market tells us through transactions what's the market price. So it turned out to be a very elegant solution where we have the provenance and the transactions all built into one. And now the last thing I'll mention as a result of that is that the coins and bars are now starting this year able to issue a currency. And that currency is basically 1/50,000th of a bar. And so the computer chip issues 50,000 carats. Each carat is worth around $1. And we think that's going to be a breakthrough digital asset that can be used for payments where you're not using a virtual currency and you're not using money. You're actually legally using a commodity title to make a payment. And that means you don't need a money transmitter license, which is very important if you're a platform like Twitter.
Yeah, tremendous. Thank you for that. When I heard the use of the blockchain for Diamond Standard tracking provenance of the diamonds, that was when it clicked for me. I was like, okay, this all makes sense. This is very intelligent use of technology. We're in our final round because I'm looking at my massive list of questions, and I feel like we've all touched on each of them, and I don't want us to go ahead and repeat ourselves, and I want to give a little bit of breath for each of you. And I guess we'll start with David as the final question. So I would like each of you, and we got 10 minutes left, so to I guess share a prediction or an expectation, or what is it that your organization is looking toward in the remainder of 2024? I even push into 2025. I know it's difficult, the speed with which our world moves at this point, to make predictions there, but David, read the tea leaves for us for the team at FarmTogether.
Sure, I can take a stab at this first. So for us, I think our prediction for 2024 is that there's going to be a casual event in November that many investors are going to be paying attention to, and I think it's going to really set the cadence for allocations and investments for the year. It's something we're seeing already. So we saw high activity to close out 2023. We actually just launched one of our larger deals on our platform this week, and we've seen a record syndication pace for it, which underscores, I think, this notion of, there has been capital on the sidelines, waiting to see what inflation is doing, waiting to watch the Fed, waiting to look at global macro. And now we're entering a period where there's going to be a huge macro decision made in November. And so I think we're going to see capital moving off the sidelines in the first half of this year at an above average pace. We're going to see more activity than normal. And I think as we start to get into Q3, we're going to see activity fall. It's going to become slower than usual and come to a pretty heavy pause as we see what the general election brings in the US, and obviously all the implications that will have on the macroeconomic picture.
It's funny, as you were speaking, it dawned on me, and I will ask you this one follow-up question. How long has FarmTogether been around?
We were founded in 2017, and we've been deploying capital since 2019.
Thank you. All right, Anthony, you have the floor. Tea leaves. Talk to us.
All right. So I think most of us who drink whiskey, or maybe who don't, are familiar with single malt Scotch. Right? It's really considered the most, the most sort of like high-end or luxurious type of Scotch. Just 18 months ago, the U.S. approved a new classification called single malt American whiskey. In the last couple of years, there has not been any sort of advances in terms of classifications in the American whiskey world, despite it being the fastest growing category behind tequila. And we're seeing now the growth of single malt American whiskey really outclip any other classification that we've seen across both whiskey and wine. I think the craft brands in the America are really taking to it, and we're really starting to see the prices as well to reach closer and closer to what a single malt Scotch is. So our prediction for 2024, right, is going to be that single malt Scotch and is going to sort of lose its #1 spot in terms of growth. And single malt American whiskey will be our fastest growing category within the wine and spirits investment world.
That's fascinating. I had no idea about that. I'm going to ask you a follow-up question. I wasn't planning on this. I apologize. Bit of a curveball. You mentioned tequila, and pardon my ignorance, but I don't know do you offer tequila as an investment vehicle via Vinovest? I know you guys have whiskey and wine, and if you don't, is that a plan for the future?
Yeah, so we don't right now because still over 90% of tequila that consumed is Blanco, so not really aged at all. I think the key component of our asset class is the aging component. Right? People like to drink their wine aged. People like to drink their whiskeys aged. But we are seeing more and more investors start being interested in terms of a demand standpoint for the añejos, the extra añejos, right, that are aged for a minimum 3 years up to 5 years. So as that consumer market and palate develops, we'll start to see more investment opportunities as well that go along with it.
Fascinating. Thanks, Anthony. Mr. Kinney, we've got 6 minutes left. The floor is yours.
I won't use it all. We think that actually this is the year of the diamond. 2022 to 23 had a relentless price depreciation. Prices fell every single week for 20 months. And as I mentioned, that's because of diamond dumping by Russia to fund Ukraine, and also the supply at the end of the COVID boom, where all the mines went into overproduction to try to catch up with growing demand. And more recently, diamonds hit a bottom. And since then, since November, diamonds are up about 6.5% after almost 2 years of relentless declines. And so what we've seen now is a flurry of interest from distributors. And if you look at the gold market, the Barrick Gold does not sell any gold at all to investors. They sell it to refiners, which sell it to bullion dealers, which go through the LBMA, and it goes through a business to business distribution platform. And a lot of that distribution for gold goes into securities. So what we're seeing at Diamond Standard is a rapid development of distribution channels. We announced earlier, late last year, we have a distribution agreement with GBI, and they're the largest bullion distributor to large banks and wealth management platforms like Bank of America and UBS. And so starting this year, they're distributing diamond commodities to the Merrill Lynch clients, or at least it's accessible. There still has to be an approval by Merrill Lynch. We're soon to announce approval for an exchange traded fund somewhere in the world, a listed product, which is what a lot of investors prefer. They don't like to hold physical commodities because you have to deal with the custody, the insurance, et cetera, and the fees. They'd rather just have a stock in their custodial order book, and that allows a lot more trading with market makers. So we think that the ETF will unlock a lot of demand. I mentioned already we have approval for futures and options. That's going to allow hedging, and I think you'll start to see. We're about to announce this quarter, a very large distributor in Europe is going to begin offering coins and bars in Europe, and we're going to provide custody in Switzerland, which means that there's no VAT tax. And then we'll have a trading venue in both Europe and in the United States. Over time, we're going to back away from directly selling our commodities. Right now, we're approaching 10,000 investors, which are family offices, individual investors for the large part, and family offices. But once we have the market making services of this large distributor in Europe, which is a very large brokerage company, then for the first time, diamond commodities will be accessible to institutional asset managers, firms like PIMCO or BlackRock, State Street. They can't buy diamond commodities right now because they need to buy them through a market maker that can provide a lot more liquidity than what's available on our exchange. And I saw one question, how liquid are the diamonds? It really depends. It's volatile. Sometimes that spread is inverted. We've had people buy diamond commodities and then the next day sell them at a premium if there's a large demand coming in through the spot exchange. And we have now a fund which is approved to list on an ATS here in the United States that also buys through that spot market. So it's a lot comes down to timing. If you're a patient seller and you set a price, an ask price, the market will often come to you and you can sell at the price you set. If you're in a hurry to sell, like a lot of markets, and you take whatever the current bid is, you might get a lot less. So the yield and the liquidity on the diamond spot exchange really depends on your patience and sophistication as a trader. But anyway, we think it's the year of the diamond as a lot more financial products come out.
Well, you were right. You didn't take up all the time, so that's that's perfect. David, thank you so much for standing in for Artem. You provided such great information for all of the attendees. We greatly appreciate it. Anthony, always a pleasure. speaking with you and learning about all the exciting things that you and your team are doing at Vinovest. For us at Diamond Standard, it's really an honor to be associated with both of your companies. We're all doing really impactful things to the alternative investment community, and I think going with the flow in changes in technology, changes in the economy, and changes in our world globally as investors. So it's very exciting to be a part of it, and I greatly appreciate everybody's participation in today's webinar. To address some of the questions, yes, we will send this as a recording to everybody that registered for the webinar. And again, if you do have specific questions for each individual leader from these companies, please just email hello@diamondstandard.com and we will disperse those questions to, .co. See that? But that's it. Thanks so much. Take care.
Thank you, Chris,
Thanks, everybody.
for attending.